Hey guys, welcome to the program. I am super stoked about this one. This is episode number 50 of the Wealth Circuit Investing Hour, and we're just excited to be here. I thought how fitting it would be for the 50th broadcast to feature the three people who were on the very first broadcast. So I thought I would share a little picture for you guys. Are you ready? Oops, that's not goodness. It. Hold on just a second. Let me get back to it. It's live or it's Memorex, right? So there we go. That's much better. Beautiful. This is a picture of the very first stream. And look up here in the corner. There are 12 people watching us. I don't even know how long ago this was. It was at least a year ago, right?
Yeah, I was going to ask you. Kevin, if you knew the exact date on that.
I tell you what, I can look it up while you guys chat about questions and stuff. So,
well, first and foremost, I mean, thanks for having us on for what is a very special live stream, episode number 50. Man, that's quite the milestone. 50 consecutive streams. Well, not consecutive, but 50 streams is a lot. I guess you enjoy doing these live streams, huh? I feel like as time has gone on, this has kind of become your bread and butter on the channel, right?
Yeah. I mean, this is what I love to do. I love to talk to people. I love to interact. And, you know, the making the videos, editing the videos and all of that it's a lot of work, right? I mean, you guys know it's a lot of work. And, you know, I guess many people don't know this, but at least from my perspective, there's not a lot of benefit there. There's, very little compensation from YouTube for small channels like mine. So it's almost like you have to find some other reason, right? This is not about, it's not about money at all. It's about, finding a group of people who are like-minded about investing. And I think that's what we've done, right? And so, it's just a really cool group of people. So that's why I like the live piece of this is because, first of all, I don't have to edit it, right? And now I do prepare for the programs before time, but it's not, stopping and saying, oh, I should have said that differently, or, there's not all this editing that goes on. So, yeah, I really enjoy the live piece of this. So, yeah. And if I'm going to do it, but if I'm going to do what I enjoy about it, then why not just do the live piece, right?
Yeah, I would say that's not to go on a tangent on this, but that is the really cool thing about doing this whole content thing is you can really make it work the way that you want it to. You can really fit it in however you want. And, I think I can speak for Russ when I say this, but we share that same sentiment where this live streaming is just so much fun. I know for me doing the weekly lives it's one of the highlights of my week every week. And I think Russ feels the same.
It's a good time. And Kevin, by the way, I was down with the mayor earlier at City Hall. The people of the greater Chicagoland area want to wish you a very happy 50th live streaming anniversary episode. Well, it's not your anniversary. Oh, it is your anniversary. No, it's a 50th
episode.
I don't know. Episode. Yeah. Is it an anniversary? Because 50th anniversary sounds like 50 years. You confused me. Remember, I'm Cook County educated, so you got to take things easy and slow with me.
So first of all, my first question is, did they give me a key to the city of Chicago? That's what I want to know.
It's in the mail. They lost it. They're looking for it. They thought maybe they could swap it out with a Lou Malnati's deep dish pizza for you. They'll put it on the dry ice. They'll ship it right over.
I think I'd rather have that.
I ain't going to do much with a key.
Yeah, I hear you, man. So, I really appreciate you guys being here. And by the way, the very first broadcast my very first broadcast where the three of us were on was May 21st of 2023. So it's actually been a year and a half, over a year and a half.
Wow.
It took me that long to get 50 episodes.
Man, time flies.
Yeah. Yeah. Wow. It doesn't seem like that long, does it?
Not when you're having fun, no.
Yeah.
And this is fun.
Yeah, it's a blast. So let's see who all's on. I like to kind of do this. I like to kick it around and see who all's here. So we got Michael Swami. And Michael is asking how the bees are behaving this year. And I will say that I was a little frustrated with myself on Saturday. I went around to the beehives and I didn't see any activity in one of the beehives. I have 4 and I didn't see any activity in one. So I got my suit on, as I have learned to do, because if I don't get my suit on, they will sting me. I've figured that out. And I opened it up and it was full of dead bees. So I have no idea what happened. My guess is they got into some kind of chemical, some kind of poison, and it basically killed off the hive.
It's a murder mystery.
Yeah, murder mystery, and there's no evidence and no witnesses. So I'm not really sure where I'm going to go.
All of them, they were all dead. The whole hive, huh?
The whole thing. Found the queen and everything. They were all dead. So
wow.
Yeah, it was awful. So how are they behaving? The 3 hives are behaving well. The 4th, I should play taps, right? I should have that somewhere in my program here to play taps. But so I have taken those frames and I've put them in the freezer. And the reason you do that is in case there are any pests in there, like mites or moths or anything like that. Kill anything off that's in there, and then I will take them and put them in storage and protect them from pests. And then the most valuable thing for a beehive that a beekeeper can have is what they call drawn out comb. And that drawn out comb is where the bees will actually, draw the cups out from the inside, and that's where they put their honey or their eggs or whatever. So having that drawn out comb is really valuable. So I'm keeping that. That's one you guys wanted, isn't it?
Hey, it's educational, and I'm sure there's an investing related insight there somewhere.
Yeah.
You know what I was just thinking, Russ? You'll remember this from what I learned about investing from Darwin. Remember when he was talking about the bees dancing? Do you know about that, Kevin? And maybe you could probably shed some more color on this. So when bees, and I don't remember all of the specifics, but when bees go to find a new hive, to start building a new hive, they'll fly to, different areas, they'll spread out, and they'll come back and they'll do this dance. Yeah. And the more dances that this particular location gets, the more favorable it's supposed to be. And in time, and Russ, I'll pass it over to you to tie it back to investing in a sec, but over time, the entire hive comes to an agreement on what the next hive location is going to be based on these dances.
Yeah, that's I know Charlie even talked about that before. Charlie's mentioned the waggle dance that the bees.
Yeah, the waggle dance is what they call it. Yeah.
Yeah, and it is just like investing. I mean, your portfolio is like a hive. You gotta maintain it. You gotta see what's going on. You can't. This is breaking down somewhere. It's going to break down at some point.
It's more so people piling into certain stocks. People pick a stock and get latched onto it, and then there's this vicious cycle that begins where it starts to pick up momentum, and then that brings more people entering into that position, which pushes the share price up even more, which then brings more entrants doing the waggle dance into that stock till eventually the hive gets a bit crowded and it can no longer sustain the participants. And then there's only one direction it can go from there.
See, I didn't remember that. It's a great book. And I think, I'm struggling for Christmas gifts here. I tell everybody I got everything I need, but maybe I should get that, because there's certain books that I really enjoy and I'll read 2-3 times. And I like to mark them up. I like to pencil them. So those library doesn't favor when you do that. So I just decided to get those books. Anyway, so
yeah, I love that correlation there, Ryne. That was really good, actually.
Kevin, you would really like this book. If you're looking for, and all of you guys watching right now, if you're looking for a great investment book to read, I'd highly recommend it. What's I learned about investing. It's called What I Learned About Investing from Darwin by Pulak Prasad. I actually learned about it from Russ, and it's been probably the best investing book I've read all year.
It's great. It's a really good. Like I said, I've read it. I've listened to the whole audiobook twice, but I think I like touching it. I think you do get some more tangible. You remember things a little bit better when you do read it. But it's a good one.
It's a good one. All right. Well, let's see who else is here. We got Fast Eddie. Hey, thanks for the happy anniversary. And what I called it is the 50th show anniversary. So I didn't call it my 50th anniversary because I haven't been on here for 50 years, but it's the 50th show anniversary. So,
Kevin, I think you've got another good 50 years left in you doing this.
I don't know. I feel like I'm already 112. I went to the chiropractor today because lifting that hive and stuff, I somehow threw my back out, my lower back. So I didn't sleep well last night. So I went to the chiropractor today. First time in years. So we'll see how it works. We'll see how it does. So, but yeah, hopefully there's 50 more, but I'm not sure I'll be cognizant at that point.
You'll be convalescing and drooling on yourself somewhere.
Yeah. So get yourself a sundae from McDonald's if the machine is working, and I doubt that it is. We've got my buddy Pat on, and that's great. Shannon's here. It's a great cast of characters tonight.
Got the usual suspects.
Yeah, the usual ones. Of course, we know that Russ is on, so there he is. Rust Moments is here. And Billy Johnson says, now Billy, as you guys know, is in the Philippines, so he's joining us actually in the morning. And he says that we got on just a little bit late, but he thought we were I was out harvesting honey. And
Billy's in the future, I like to say.
Yeah, that's right. Let's see here. Yeah, ex-dividend dad, I am doing just fine. And I don't know, Ryan, if you saw in the Discord where ex-dividend dad thought you were going to be reading the 12 Nights of Christmas or something like that. So that's awesome. All right. Oh, Greg is here. Greg, Ray. Who's BB84? I don't think I know who you are. So welcome to the program, my friend. And it looks like you're coming from, I don't know whose stream that is. I think it's Ryne's. No,
probably Russ's. Yeah.
Yeah, it's Russ's stream.
So that's cool. So all the comments from Russ's channel are getting pulled into this one.
Yeah, it is.
Awesome.
So you can see, you guys can see this, right?
That's Travis. That's my guy Travis, the dividend collector. I didn't know that was your handle, Travis. What's up, man?
So you can see that little circle thing with the line. Can you see that, guys?
I can't.
Yeah, I see. It's the link. Yep. I see that link.
And that's the link that shows. Yeah. Cool. And then Lisa J, I know she's one of yours, Russ. I see her on your channel from time to time. And Boaz Hansen
from the Netherlands.
Awesome. Yeah, it's great to see you guys. Fast Eddie wants to know if your candle is burning, Russ.
Yeah, it's burning all right. I mean, I don't know. It's a cheap one. I paid it. I got it at a discount store, so might need to keep an eye on it. But yeah, it's lit.
Awesome. We
Candle's
got
burning. I'm live.
Gorilla Nurse. My daughter's a nurse, but she's not a gorilla. So, and we got Dividend Dude. El Dynamico, one of my favorites. Antonio. It's good to see you, buddy. Let's see. I'll have to stop this at some point. Rick is on, and so yeah, we'll hold on for just a minute. But I thought maybe the first question I would throw out to you guys, and maybe it'd be interesting for the group as well. And I got this actually from my Discord. I have this channel. Yeah, I guess it's called a channel called Questions for Kevin. And so sometimes people will go in there and ask a question, right? So a question came up, and I thought I would share that with the group and with you guys. What are your top stock picks for 2025? This comes from Honeybee. I mean, what better person to be a subscriber to my channel than somebody with the handle of Honeybee, right? So that's awesome. So Honeybee wants to know, what's your top stock picks for 25?
Russ, why don't you kick it off, man?
Oh, it's
I got to
simple.
think for a minute.
If we're just throwing out top stock picks, for me, it's Visa and Costco. They're grossly overvalued. I'd love to be I'd love to individually own Costco, but it's, as I'm watching Tesla now up on what 100% since the election day. It's nutty. it's starting to feel, and granted I was around, but back in 99, 2000, let's just say I wasn't really focused on investing when I was 21, 20 years old. No, I was 21 and 22 then. What am I saying? But uh, everybody said that valuations didn't matter. Some people were upset at fund managers or people that had doing investing for them. They're like, why are you only getting a 40 to 45% return on my money? Like garbage. I'm pulling my money out. Like you should be getting triple digit returns every year. It's crazy. So it kind of feels like that where, and Kevin, you were around, perfect thing. You might remember that fundamentals didn't matter. It just didn't matter. You just buy the ticker. And I feel people are doing that with like Palantir, Tesla, I saw a comment about MicroStrategy up there from Gendry, where that one is just insane that they own, I don't know, $45 billion or so, 40 billion of Bitcoin, I think. But the company's market cap is like 100 billion. Anyway, people are buying that to get exposure to Bitcoin, I think. It's a crazy time. It just feels like Trump won, buy Tesla. Just whatever price it's at, just buy it. No, it doesn't matter. And you start to see that, and it's like this just can't go on forever. I mean, every day, like I think Tesla was up almost 9% today. Wow. Every day I look, it's up 2%, 5%, 8%. I mean, it's at some point, right? Fundamentals have to matter. So for me, I'd love to get Costco and Visa. Those are two, but I know they're not really high yielding stocks. So that's. I know you might ask a question. I've got my psychic sense is tingling here, but about how we've changed and what we've learned. And it is. I don't know. Those are some low yielding investments I'd like, but then also, I guess what I'm buying, I'll end with this, is Vici Properties. I'm still buying Vici, and I'd like to buy Agree Realty too, more of that. But I think it's a little expensive. So I don't know. Those are some, and if you give me more time, I'm sure we could all rattle off dozens more.
Yeah, you only have like 12,000 to choose from. So, Ryan, anything come to the top of mind for you?
Yeah, I'm with Russ on both Visa and Vici Properties. Those are two that I would like to add to in this upcoming year. And I think the theme with both of our answers is we're not really, when it comes to the top stocks we want to buy in 2025, it's not really which ones are the best valuation going into 2025. It's more so which ones would we like to accumulate more shares of. Visa's top dog for sure. And I don't think, maybe my situation's a bit different than yours, Russ, but I don't think the valuation's as bad. And maybe that's just because I have more time on my side to let Visa play out until I plan to start using the dividends. So I would be okay buying, and it's not as good as it was, but I would be okay continuing to trickle into Visa. It was much better when it was, 260 and below, which really wasn't that long ago. But I don't know. We'll see what happens. To your point too, things have been very frothy across the board, so we could see a pullback. You
just reminded me. That's a lesson from everything we read. I think again, going back to Charlie Munger, God rest his soul. We don't want to make him swirl in his urn, but he he's talked about when you see these opportunities, like going big into them. And one of my mistakes was I had funds to buy a lot more Visa in the 260s and 70s. But I'm like, it might go down. I like it here. I feel comfortable buying it here. So I was like trickling in, like a share here, 2 shares there, and then So I think that's one thing I've learned is that if you're comfortable buying something and it's something you want to hold for a long time, just go in big. Just stop. I farted around like buying a couple shares here and there, like almost DCAing into it. So, and I don't know. That's I don't know. What do you think? You would lump sum buy just all at one shot, or you just prefer to buy a few here and there?
Yeah, I think for me, I learned that same lesson, Russ, because I ended up with a portfolio of like, I forget how many, 48 stocks or something like that. And it was because I would start small, right? I'd buy a few little shares and then I would wait. And what I've learned is that investing in the stock market is an experience of perpetual regret, because it doesn't really matter what you do. You're always going to regret something. right? So if I go in slow and I accumulate some shares, even if it's small, and the stock price goes way down, I regret having bought those shares. I mean, I should have waited. And if I go in small and I accumulate a few shares and the stock goes way up, I regret not having bought more, right? So regardless of what happens, there's going to be some sense of regret. So as an investor, we just have to get used to that and understand that we're making decisions, and we make those decisions based on our rules and where we go, right? So what I ended up doing, Russ, is I made a rule for myself, and I said, if I feel good enough about a stock to buy it, I'm going to buy at least 1% of my portfolio in that stock. So I have no stocks in my portfolio that are less than 1%. I sold everything off that was less than 1%, or either that or I added to it, right, to get it above 1%. So everything in my portfolio has to have at least 1%. My max is around 5%. And so I guess my normal weight's around 3%. And then if I'm overweight on a stock, I'll go to 5, and I'll let it run up further, right? I'll let it go up to 6, 7, 8%, as it runs up. But then when it gets to the place, my target, then I'll back it back down. So
I just saw Adam's comment, and he dovetails nicely in with this, where he says, just wait for bad news on great companies and then be patient while it plays out. I think we're seeing that today. So breaking news, everybody. I liquidated my PepsiCo and J&J positions, and it was a little tough when I hit sell, but I feel, well, it made it easier, or it made me feel a little better that after I sold both, they continued to go down. But honestly, I sold PepsiCo at 158, which is tough because I have 100 shares with a cost basis of like 150, but with all the dividends and options income, I'm in the 130s with it. But man, it was a year and a half ago. It was pushing $200 a share, so that was like a $4,000 gain almost for me. Yeah. Almost 150 to 200, almost a $5,000 gain, and now I just got like an $800 gain, just not counting dividends and option income. But I sold it at 158, all 100 shares, and then in after hours it was like 155.74, I think is last I saw. So that's gotten whacked. And then J&J I sold at 146.75, which, man, that's difficult because, right, we've seen it in the high 160s, and I had 113 shares. That one I actually took a little bit of a loss on. I think I lost like 2% maybe. So that'll be a tax loss harvest. But that's bad news, right? That's actually down to 143 and change. And it's all because of, like I was telling you, Kevin, earlier, that if everybody's worried, the market hates uncertainty. And with RFK, if he gets confirmed as the HHS head, who knows? Who knows? So everybody's worried. That's in junk food companies and pharmaceutical companies, because he wants everyone to eat healthier, skeptical of vaccines. So I don't know how much power he has to unilaterally do what he wants to have done. But that's that. For those of you, what do you guys in the chat think? What do you two? What do you think about like a J&J? Because I think all the pharmaceutical stocks, like almost anything, healthcare, pharma, like health insurance especially, it's just gotten whacked hard. So, what do you guys think?
Well, my initial reaction is to think that it's probably how it will play out in reality is not as bad as what people have in their minds, waiting for it to play out. It seems, and I don't know, I could be wrong, but it seems that's the general case with a lot of these things. And when it comes to a lot of the uncertainty we do see in the market, it's never typically as bad in reality as you think going into it. What really ends up crushing the market is like black swan unforeseen events, these things that we can't predict and don't even think about, that come out of nowhere to really, send things heading south. So when it comes to something like Johnson & Johnson, which has at this point been around for, well over a century, probably close to a century and a half at this point, maybe even longer, I'm sure that they will live to tell the tale.
I should preface something. I don't think I've met Gendry before, but he said bad move, never sell Pepsi, and it's time to buy, not to sell Pepsi. But so here's the backstory. I have a family. We have teenage daughters, so we do a lot of driving around. We were driving around 2011 GMC Acadia. Those are lemons. We won't get into it. Has almost like 170,000 miles on it. So we needed another car, and we always buy stuff that's like 5, 6 years old. My wife's been doing all the legwork. Anyway, long story short, we bought a 2021 Volkswagen Atlas. And it's really beautiful, top of the line car. We paid $31,000 for it, which it sounds nuts to me, but that's what good quality used cars are going for. Because I've seen hunk of junk stuff and it was like 22,000, 23,000. I'm like, oh my god, this is still crazy. But anyway, so I don't want auto payments. We financed it at a 7.69% interest for the 4-year loan, but when I pay that off, that's going to be a guaranteed 7.69% return on my money. And I just, I'm young. I'm only 7. I was born in April of 78. I just forgot how old I am. I think I'm 7. I don't know. But anyway, I think I want to find something with a little bit better total return potential. And because I have a lot of years to compound still, and I still have exposure to PepsiCo and J&J and like SCHD. I don't remember if J&J is in SCHD. I know PepsiCo is one of the bigger holdings, but I also have mutual funds, so I still have exposure. But and then we're going to be paying ourselves back bi-weekly, so we have essentially gave ourselves a loan. So I'm going to be putting that money back until it's all accounted for, and then rebuying different positions. So. Yeah, that's the story on it, Gendry, and I should have sold it earlier, and that was something we've talked. It's going too long, but we don't need to go down the personal finance road. So that is why I sold J&J and PepsiCo, and just the added fuel to the fire of all the uncertainty. Now is, it's unfortunate that they've dropped, but hey, could be a good long-term buying opportunity.
Kevin, what do you think about going back to J&J? What do you think about all of this stuff and the reaction that we're seeing?
Yeah, so as Russ was talking, I'm reminded of something that he says a lot, which is, and I think it's about insider trading, right? But it's there's many, many reasons people sell stocks, but there's only one reason they buy it, right? And that's because they think it's going to go up in the future. So, Russ has his reasons, right, for selling those, and it's a lot of times the reasons to sell. And I've had my sales this year as well. I sold off some, I don't remember what I sold off. I put it in the Discord, but anyway, I sold off some shares of Pinnacle West, one of my favorite utilities. And so I sold out of UPS. I sold out of UPS. And why did I do that? Because, the portfolio has just been really blessed this year, right? So the portfolio has gained around $300,000. And so, what my wife and I decided is that we have been blessed, and so we're going to bless others. And so I sold off some stocks to actually give that away. And that's
I want to thank you again for you helping me out there. That was great.
Yeah, I still have your bank account number.
Oh, good. Sorry, I didn't mean to cut you off.
No, that's okay. So, that's a reason to sell, right? That's it's not because I didn't like those stocks, but it was a reason to sell. So there's a lot of reasons people sell, but specifically about J&J, I still own J&J. It's still a piece of my portfolio. Now, I will tell you this, back what was it, 8-10 months ago, it was trading in the 140s, like it is now. And then as that lawsuit got kind of, moved forward, I guess, it went up into the 160s. I had about 7% of the portfolio in Johnson & Johnson at that time. So my spidey senses went off, and I was like, I don't think I need 7% of the portfolio in Johnson & Johnson, but I don't mind having a normal weight of Johnson & Johnson. So I took it from 7% of the portfolio down to about 2.5%. at, in the 160. So I'm still holding it. And I think in the long run, which is my perspective, my investing perspective, I think in the long run, it's going to continue to grow slowly, 5% a year forever. Right. And I could be wrong, but that's what I believe. And so I need some of those shock absorbers in my portfolio. I am retired, so it does help to have what I call shock absorbers, which are things that just don't move as much as some of the other quicker moving things. So it kind of helps.
You're in wealth preservation mode, right? Ryne
Exactly.
and I are in wealth accumulation. I mean, he's even more in wealth accumulation than I.
Yeah.
But yeah, we're both wealth accumulation. You're
Yep.
in wealth preservation, so that's going to affect like how you do things, right?
Yeah, so Johnson & Johnson might not make sense for you guys, but it might. Depends on what you guys want to accomplish. So.
Well, here's how I think about it. It's in my portfolio positions like Johnson & Johnson, Procter & Gamble, even Realty Income. I look at those as pillars of stability in my portfolio. They may not see as much upside when the market is booming like it has these last couple of years, but when times get tough, which, man, I can't help but think that that's going to be somewhere in the near future. I could be totally wrong. But when that does happen, I think that those will be really good defensive positions to have. I think I'll be happy that I have those in my portfolio at that time. And when it comes to total or your returns in your portfolio, we kind of forget about the downside, especially these last couple of years when we have been so blessed to see things do really stinking well.
Yeah.
We kind of forget that things can go in the opposite direction. But
no, we stopped doing that. We canceled it. No more.
Oh, right. But if we saw another 2022 like scenario, which was really like the last bad year, I think the S&P was down close to 20% that year. If you can see much less of a drawdown from having some of those defensive positions across a long period of time, when you take into consideration the market cycle, the ups and the downs, having that defensiveness and that resilience could lead to overall outperformance when you zoom out and look at the bigger picture.
Mm-hmm.
The good old days, man. I miss that when everything seemed like it was on sale.
Yeah.
Someday it's got to happen.
So that's something I think about a lot, because especially when it comes to positions like J&J or Realty Income or some of these more stalwart companies, you could certainly make the argument that I'm probably too young to have those, but I think they play an important role in my portfolio and create a sense of balance that helps me feel more comfortable with what I'm doing.
Yeah, I like that. Whiskey Tango Foxtrot. What's up, man? He shared a thought that said J&J's been flat for 5 years. So I haven't fact checked your number, my friend, of real inflation being at 8%. But let's just say it was at 8%. Then yeah, I mean you're going to have a real lot. How do you say that? You're going to have a net. I can't think of the word.
But what's 5 years in the grand scheme of things? What is 5 years? It's a drop in the bucket. Mm-hmm. And at least for now, the days of inflation that high, they're gone. They're behind us. And so I don't think it'd be fair to look into the future with that number hanging over us.
Yeah. Yeah.
Hey, be still said, am I still keeping the shirts though? So there we go. I still got. I don't care. I'm frugal, baby.
I thought you were about to flash us, man.
Well, that'd be extra, man. My wife might want some funds if that happened.
Yeah, there you go.
Free. She says she bought and paid for this, so
that's right. She gets the royalties,
remuneration. That word throws me off when you read, Buffett stuff. Remuneration.
Remuneration. Yeah.
How am I saying? I got an accent.
Remuneration.
Remuneration. There it is.
Yeah.
I always want to say remuneration. So, hey.
Yeah. So my stocks for 20. I'll just. There's always details, right? And I love to share the details, but I'm not going to worry about any of that. My stocks for 2025 at the moment. I'm going to throw a couple out here, and then I want to talk about one and about what's going on in that industry and get you guys' take on it. So I'm going to say Elevance Health, which is one that I've been touting here for a bit. I am down on it. I don't know how much, but it's about 3.5% of the portfolio right now. So I am continuing to buy that. I will buy some more soon. I don't have a lot of cash in the portfolio at the moment because I drew it all out. And but anyway, I'll sell something off and buy some more Elements Health. That to me is gonna do well. United Health, I think if you're looking longer term, I think United Health is at a good place at this point. I don't think it's going to come. I mean, with all the intricacies of what you were talking about a while ago, Russ. Not sure it's a next year kind of thing, but if you're DCAing in, it's not a bad stock to DCA into. It takes you a little while to build up a position anyway, so why not throw a few bucks at that? Oh, and you guys, have you seen what's been going on with my French fry company, Lamb Weston?
No, what's been going on?
Well, there's a rumor now that Post is going to make an offer to buy them, and where it went down to into the mid 50s.
Yeah,
I bought some in the mid 50s. It closed today. Let me look. It closed today at 82.
No way.
It's been smoking, man. I think it's gone up
crazy.
Yeah, it's gone up like 10% in the last 2 days. So,
jeez, that's crazy.
Yeah,
that's the thing about the market, man. It's you're down one day, the next day it could be the complete opposite. It's just such a crazy place. Well, that's awesome. I'm glad that it's working out well for you. Is Post publicly traded or are they private?
That's a great question. I don't know.
I
see Russ tickling the ivories there, so we'll let him look that up.
Okay. I'm just chatting to Zach, who says if we're not buying a little bit or having exposure to Bitcoin, we're doing it wrong. So
yeah. So here's the other one I thought I would throw out to you guys.
Sorry.
It's there's one that came onto my radar screen. I have this super duper spreadsheet that I use, and it looks at various factors. I use Morningstar data, I use TipRanks data, I use Simply Safe Dividends data, and I pull all that together, and I actually rank the stocks based on what I think their returns are going to be, let's say, over the next year or so. And almost like an analyst would do, right, where they give you kind of a year target. And that helps me prioritize when I'm going to buy. The one that hit the top of the list, and I don't own it yet because I've got some reservations about it, is ConocoPhillips. COP is the ticker symbol. It's an oil and gas company. They are according to Morningstar, they're about 13% undervalued at the moment. They have a 3.1% dividend yield, 61 dividend safety score, 15% return on invested capital. Wow. So my program, my methodology says that I'm looking at a 39% return over the next year. The analysts, the top analysts that cover ConocoPhillips, are saying 43%. So there's something in the numbers that looks really good. The challenge, and the reason I think that it is undervalued at the moment, is what happens in a Trump administration with the drill baby drill, right? And so as I look at even the near term, what do I think the prices of these stocks are going to do? And should I wait or should I buy some now? What do you guys think about it? Is there anything to that, or am I just being crazy, or what do you think?
So ConocoPhillips, I was just looking, they have a 5-year, you like this, Ryne, because that's where I started getting big into ROS, return on capital employed, 19%. So and our friend Pulak Prasad, who we should talk to someday, likes 20%. But yeah, it's just, I brought it up here, return on capital employed. It just shows how efficiently a company uses its capital, both equity and debt, to generate profits. So yeah, I mean, I think it's fine. I think it's, dude, oil's not going anywhere. It's gonna be It's gonna be around for a long time. And I know everybody wants the EV, and that's cooled off a little bit. But I don't know, man. I've never dug into it. I mean, I still hold Chevron and Exxon, but I think it's needed.
They don't do as much upstream and downstream as something like a Chevron and Exxon, right? Like, as ConocoPhillips, do they have gas stations, or is it just like the exploration and drilling?
They have some. Yeah, they have the Phillips 66 gas stations, and
Well,
but it's not as big as those others. Yeah.
it could be good then if they're kind of more on the, what is it, the upstream side where they're doing more of the drilling, because we could see more supply coming into play, which would probably benefit them more. So yeah, could be good.
They just finished the acquisition of Marathon Oil, which is that upstream that you're talking about. So they definitely have some upstream assets. So yeah, I don't know.
And yeah, 40% return. I mean, that sounds pretty nice. What are some of the numbers that you're using to come to those conclusions? Like what's that process look like? I mean, you can give the Spark Notes version too, because I'm sure it's kind of complex, but
yeah, well, it's not as complex as you'd think, but I look for three things. I look for what do I think the yield is right for the stock, and if they pay me my dividend, I'm going to get that over the next year, right? So if their yield is 3%, I'm going to get at least 3%, right? Then I look at what is their this is going to be kind of weird, but what is their valuation, right? Are they over or undervalued? And I realize that many times it takes stocks a while to come back to their fair value. So let's take Johnson & Johnson, for instance. It took, with this lawsuit, it took many years, right, for that to actually come to fruition. So I take the discounted, if they're discounted, let's say ConocoPhillips is discounted 13%. So I will take that 13% and I will say to myself, I do not expect them to get back to full value in 1 year. But I do expect it to be by the fourth year. So I will take that and divide that by 4 and add that to my dividend yield. And I say, I believe they're going to recover 1/4 over the next 4 years, 1/4 of their value that they're being undervalued. And then I look for their dividend growth, and the dividend growth, this is the complex one, right? If they've got the metrics that support the business growing by what the dividend is growing, then I believe that the business will grow at the rate of the dividend. And that's so cool. Why do I think that, right? I think that because the board of directors have insight, and this is one of the reasons I'm a dividend investor, right? The board of directors have insight into the future. They have models, they have forecasts that we don't get to see. And they will look at that and they will determine what these dividend growth numbers are. And as fiduciaries of the company, they can't really go outside of what their forecasts are saying. So they can't, or they could get sued, right? So if the forecasts of the company say, hey, we're going to grow by 10% over the long term, then they can grow the dividend by 10% and they'll be okay. So I take the growth in the dividend rate plus 1/4 of the undervalue plus the dividend yield. And that's what I think the next year is going to bring me. So if the company's going to grow by 10% a year, I think they're going to get that. If they're going to recover 1/4 of their undervalue, they're going to get that, and they're going to give me my dividend. And that's what I believe. So it's not complicated.
No, but that totally makes sense, especially that's a really cool combination. Dividend yield plus current undervaluation plus dividend growth. And the dividend growth portion makes sense because yields tend to hover within a certain range for companies, right? And so if a company is growing its dividend by, let's say, 10%, they have the share price to keep the dividend yield within whatever that range is, has to grow by a similar amount on average over the long term. So is that right? Do I have that right? They tend to grow at around the same rate, and they have to do that for the dividend yield to, well, let me reverse engineer it. If you see a dividend yield hovering within a certain range, that's what it means.
Yeah. Yeah. And what I use to kind of test that, Ryan, is I look at the payout ratio. If the payout ratio is flat and the dividend is growing, that means that the earnings of the company are growing at a rate that will keep paying that dividend and keep the payout ratio flat, right? Does that make sense? So if a company's got a growing payout ratio, then I'm going, hey, they really can't sustain this dividend in the future. So I discount that. I don't give them credit for it, right? if that
You're
makes
looking at
sense.
free cash flow payout ratio or earnings
No,
per share payout ratio?
I look at the earnings per share payout ratio.
Really? Okay.
Yeah. Because the free cash flow payout ratio can have a lot of things that would drive it. They may be investing in the business that would actually drive that growth, right? And so if I look at that free cash flow payout ratio and go, wow, it's going down, but it may be that they bought a business or they bought a plant, right? That's going to double their capacity. That's going to help them grow as a business. So I like the earnings piece of it. Of course, as you all know, as you guys know, there's more to due diligence than just a few numbers. But I do like to look at the earnings payout ratio.
But I think your approach is like you could definitely get a lot more weeds in, go a lot more into the weeds with it when it comes to trying to find that value. But I like that approach because it is somewhat in depth, but it's not too in depth that you get lost and have to make all these different assumptions about the future, which can definitely screw with things. So I think that's a really interesting way to do it.
Well, the thing I like about it is that the growth is coming from the company, not what I'm just expecting in my model, right?
Mm-hmm.
Because a lot of folks, when they do the discounted cash flow calculations, they'll say, I think they're going to grow by 8%. They look at their past sales growth and or earnings growth or whatever. But what I'm getting is the dividend growth, which is coming from the board of directors who's looking at the future. They're not looking at the past, right? And so that kind of gives me some comfort, right, in that. So, and here's the other thing about it is, I know I'm humble enough to know that none of these numbers that I have are going to be exactly right. But I do believe they're going to be relatively right. So, for instance, if the whole market crashes, then we may not see 39% for ConocoPhillips, right? But it's probably going to be better than, let me pick another one down the list somewhere, NextEra Energy, which is down the list, right? So relatively speaking, they're going to stack up about the same. So I think it's a relative model. I don't think it's an absolute value model. So I'm not going to say, hey, I think that as 1 year today, that ConocoPhillips is going to be trading at 39% above where it is at this moment in time, right? But I do think that it's going to be higher growth in stock price than what you would see in NextEra.
Yeah.
If that makes sense. Yeah.
Yeah, totally. Based on its current valuation and its expected growth.
Mm-hmm. Mm-hmm.
Yeah.
Now, cool. I created this back in September. And so I did save a model, I think, at the end of September, and I'm going to use it to kind of test. I'm also going to save one at the end of December, and I'm going to test this kind of going forward. So I don't want to say, hey, this is the perfect model, because I don't have enough history yet to say. But I will tell you this. It told me to buy Google, a couple of months ago. And so now I have, Alphabet. It told me to buy Alphabet. And where's that at now? So at the time, it was like number 3 on my buy list, on this list that I have. And now it's sitting at number 15. So it's saying, hey, back off of Google, right? There's other stuff that's more valuable for the portfolio. And it's caused me to sell some things too.
Oh, yeah?
But I will say that some of the things that I sold continue to go up. So like I say, it's not perfect, but
it's a good process, Sometimes the outcome can be all over the place, but it's a good process.
Yeah.
And that's what you can control, right? You can't control what the share prices do.
Yeah. And I think that kind of falls into what Adam's comments were about just waiting for bad news on great companies, right? And that kind of factors that in.
You ever look at the Chowder rule? You ever use anything like that? I think it's just the dividend yield plus the dividend growth, right? If I have that right.
Yeah. And the only difference is I'm also adding in the undervaluation. That's the only difference to that. So I think that formula is missing the what it's undervalued. And I struggled with that, guys. I'll tell you, I spent hours thinking, wow, this is getting way into the weeds here, but dividend yield is easy, right? But what about undervaluation versus
So
dividend
subjective.
growth? Are those the same, right? Is the dividend growth or the company growth, is that captured in the undervalued? I mean, it's a really complicated thing, but at the end of the day, I came to the conclusion that I believe they are separate things. I think they're separate and they should be accounted for separately. So I don't know. It's fun stuff.
Yeah,
No,
I
it
know
is.
for me, just looking for better businesses.
Yeah.
I've tried to look, that I think that's one of the things I've changed is buying cheap companies, looking for something that's cheap and dirt cheap, but honestly, just paying up, right? Paying up for a quality company sometimes has done very well for me. I mean, if something's at a 52-week high, it's probably there for a reason. Something good is going on with it. Usually, and we see our moonshots, but yeah, and here I am, right? I say that, and I'm struggling still to buy Costco where it's at, and Visa
Right.
even, but Visa, I don't know. I might just buy one at 316 here just to just to throw one more in there. It's crazy. It's crazy. But I mean, and it's funny because when I was buying it at 260, I said, I can easily see this over 300 someday.
Yeah.
I didn't think
Right.
someday was going to be, like 3 weeks from then. But I
Yeah.
said, someday I'm pretty sure this will be over 300. So why the hell wouldn't I buy it right now? And I did. And then it was just that component too of thinking like this is a really good business. It's a really good company. And they have just that it's a duopoly, right? So
Yeah.
I think it is. I mean, I know we could go on anyway, but yeah. So I don't know. There's a million ways to financial heaven, right? So
Yeah. There's a lot of ways to skin that cat, as they say.
As they say.
So, Ryan, this is for you. What we haven't heard you talk much about KRC lately. How's that going? What are your thoughts on that?
It's right now at the moment, it's looking like a really good position for me. Let me pull up my position real quick. So on a total return basis, I'm up about 23%.
nice.
Just in terms of share price, I'm up 13%. So it could be
Awesome.
better, could be worse. I think I've held it now for a couple of years. So I think I'm still seeing probably a 10+% return annualized with that position. I think when all is said and done. So I'm happy with it. From what I've gathered in the earnings calls, the last couple of earnings calls, things are headed in the right direction for them. They're seeing a lot more interest in their properties. They're seeing a lot more people spending time downtown, going back to the office. And so it does seem like that's all starting to normalize. And as it should be, it's a slow process. But I do see it heading in a good direction, and I'm going to continue holding on to it because I think there's still some upside left in my portfolio with KRC. And, like I said, things seem to be slowly but surely going in the direction that the company, and other shareholders want it to. So I think it'll still work out to be a good one. And in the meantime, getting a nice dividend yield being paid to wait. So can't complain.
So when you
Yeah.
say there's still some upside left, do you think that you'd ever sell it, or when you think it's fully valued, or is that something you're just gonna?
Yeah, I
reassess
think
when you
it's.
get there?
I think at some point I could see myself selling it, not because I think it's a bad company. It's been a good company. It's the timing of it. These last couple of years for it haven't been great. There's things that have been outside of their control that have made it that way, but they've controlled what they can in what I think is a good way. But yeah, I think at some point I could see myself selling out of it to maybe put more into like Vici properties, which I think is more within my wheelhouse. And so that would be my reason for moving those funds. It has more to do with me liking Vici more than me liking KRC less, if that makes sense.
Yeah. Oh, dude, Vici's one that one of the red flags. I'm always looking for reasons to say no. Is that they're so heavily weighted toward pretty much two tenants. With MGM and was it Caesars? I think MGM and
Yeah.
Caesars are like 70-something% of their
Wow.
income, I believe. Unless the air is getting thin and I'm smelling this candle from the discount store.
The electric candle.
They make it so. But yeah, it's just one thing. It's funny. There's another evolution of mine is looking for reasons to always say yes to buy something when it comes on my radar, and now trying to almost be like the abominable no man, you know, inverting it and looking for all those reasons to say no and then deciding if you still want to buy it. So
Yeah.
Yeah,
Yeah, I
so
will say that's one of their risks for sure, is being so concentrated with those two tenants, and furthermore being so concentrated here in Vegas. But
40-year
I don't know.
weighted average lease. Yeah, and I know some people are turned off. The market doesn't like, almost feel like a realty income where they're expanding into like, you know, making loans and or investing in Canyon Ranch and Bolero and doing, you know, Great Wolf Lodge, things like that. You know, that's we'll see. We'll see. You got to trust the management on that one.
Yeah.
yeah, you know what's interesting is that all of the REITs that I think I had 6 REITs at one time, and when I went through this, you know, getting rid of anything less than 1% of my portfolio, all of them were less than 1%. So I actually have no more REITs in the portfolio. I don't have any business development companies or REITs in the portfolio. So, but I did like KRC. As you know, Ryan, I enjoyed the time that I owned it. And
You did really well with that one, from what I
did.
remember.
Yeah, they did well. And one of the ways I look at the performance of my investments is to look at how many dollars I made on that investment. So even though I had this huge percentage gain, my holdings of KRC were so small that the dollars really weren't significant. You know what I mean?
Yeah, absolutely.
So that's kind of changed my whole philosophy around how much I'm willing to invest in a company, because if it's not going to move the needle, why do it? You know?
Mm-hmm. Absolutely. I have a couple of those in my portfolio right now. Like AbbVie's one of them. I think I'm up close to, I don't know, it's 70-ish%, maybe even higher, including dividends. But it's increasingly becoming a decreasing position, a decreasing weighting in the portfolio, to the point where pretty close here, it'll be under 2% of the total portfolio. And I'm kind of scratching my head wondering what to do with it, because I think it's a good company, but I'm not going to buy any shares right now. And I kind of, my mind always goes to pretty much what you just described, Kevin. If it's, you know, it's good, it's been good, but it's really getting to the point where it's not moving the needle. So maybe it's time to unlock that money and put it elsewhere where maybe it can do more of that. But I don't know. It's tough.
That's the fun of it, right?
Yeah, that's the fun of it. Mm-hmm.
So I wanted to throw this out to you guys. I don't know if do either of you have Hershey? Do you own Hershey?
I don't know.
No? Then maybe I won't. I've already set it up, so I guess I better.
No, they look solid. They look good.
So what do you guys think about Mondelez and Hershey breaking off the buyout? I didn't hear that they had done that, but going
the Hershey Trust wouldn't allow it. There's no way.
Right, yeah. Hershey Trust owns like 80% of the voting shares, so that was going to be a problem anyway. Going to help or hinder the stocks? What do you guys think?
I don't know. I mean, go ahead, Russ.
Oh, it's not going to happen. So I think it'll be negative. I don't think, or not negative, negligible. I don't think it's going to really have any. It's just because Hershey kept dropping, right? They just kept getting cheaper and cheaper. So that's what happens. Somebody tries to buy when things fall in price.
Yeah, I mean, truth be told, and maybe this isn't good of me, but I don't spend a lot of time thinking about that stuff, because it seems like it's just, it might have some short-term impact. And I don't know, Hershey was pretty cheap before that. Maybe it becomes cheaper now. But I don't know. I don't really, like Russ said, I think it will be negligible from a long-term perspective. I do like Mondelez, though. I was actually kind of surprised when I recently looked into it. There's some, you know, under the hood, there's some good stuff about that company.
Yeah, they got a lot of great brands, right? I think they own Oreos and
Sour
Patch Kids.
Mm-hmm. Stride gum as well, I think.
Wow. Boy, that's a blast from the past, right?
Yeah. Yeah. I remember when I was in high school, that was the rage. It was cool to choose Stride gum or 5 gum.
Look at that dividendology. Eli checking in, giving his Hershey's. He says, I didn't know that. They also tried to acquire Hershey back in 2016. They're trying again. Nice, man. I didn't know that.
Yeah, I don't know if they tried or if they just floated the balloon. There was not like an offer, but it was just a rumor. And evidently that rumor got, kind of squashed by the Hershey Trust, evidently. So I haven't read the article, but evidently that's what happened. But, I didn't buy Hershey because I wanted to see them bought, right? I think that they have good long-term value. This thing with cocoa, it's going to resolve itself at some point. It could be a couple of years, 3 years down the road. Takes a few growing seasons, from what I understand, to get some good cocoa. But I think now's not a bad time to pick up a few shares of Hershey if you're a longer-term investor. If you're looking for next year, I don't think it's the right time. But I said that a few weeks ago, and then the Mondelez thing came up, and I was like, oh, man, they went up like 10%, one day, and it was like, what I said was a long-term thing turned out to be like, a week.
Well, it's just like with Lamb Weston. Sometimes these things come out of nowhere, and they hit the share price like a ton of bricks.
Yeah.
Yeah, it was 2016. Mondelez offered $23 billion takeover offer that Hershey rejected in June of 2016, which was a 10% premium to Hershey's. Let's see if they'll let me. No, they won't let me read it. It's a New York Times article. I didn't know that, man.
Is your guys's? Do you guys? How do I ask this? Do you guys think that, because Hershey's, I don't know exactly how much it's down this year, but do you think all of that has to do with the price of cocoa, or are there other factors you think that are playing into that?
It's other factors. It's the RFK thing too. All the, junk food companies got hit hard. But,
and that really started with like the whole, what's it called? Those weight loss drugs?
Yeah, the GLP-1. That's definitely the GLP ones. Yeah, Hershey. 1 year, it's flat, down 2.3% this past year. So.
Okay.
Yeah, it came down in December of last year. That's when I started buying it. I don't have it in front of me, but
yeah,
that's when it started to drop, probably in October of last year, and then I started buying some in December, something like that. And it's what do I have?
Yeah,
it's right now about 2.8% of the portfolio. So I mean, I'm not like going crazy with Hershey. It's like a normal weight in the portfolio for me, but I'm excited to have it in the portfolio for the long term. I'm not planning to sell it unless they get bought out and then I have to, right? But I'm not planning to sell it.
So Kevin, you think you'll end up adding ConocoPhillips to your portfolio, or are you still on the fence about it?
I'm on the fence at the moment, and I think I'm going to wait to see, because you remember how big of a beating Chevron and Exxon and all those guys took during the last Trump presidency. And not that I think that's wrong. It's just that I think that they just took a beating because it's much easier for them to make money when prices are higher. So you drive prices lower and it's harder for them to make money. I think they're in a much better position in their balance sheet. All of those companies now have better balance sheets than they did before, but it's still going to be harder for them to make money. So I'm a little bit skeptical at the moment that now's the right time. But I've been wrong before and I'll be wrong again. So, you just never know.
It's fake news, Kevin. You won't be wrong again. Come on.
Oh, man. So let's see. Is there anything else here? We are now at 1 hour and 3 minutes, and you guys have been so kind to join me on this. And I think it's been a great show, man.
This has been fun.
Yeah, it's been a lot of fun.
I'll do this anytime. I love this.
Okay.
It's fun.
Right.
It's a lot of fun being able to get together with you guys.
Yeah, I agree. Let's see.
These Divs says bricks and mortar pharmacies are in trouble in regards to Paulo's comment, who said, how about WBA? How about Walgreens? Yeah, Walgreens is looking like they're in a bit of a pickle here.
The writing on the wall for Walgreens has been there for a while, though.
Yeah.
Yeah, I agree. So let's see. D's Divs says Costco and Amazon are eroding their foundations.
Oh yeah.
What say you guys about that?
Yeah, absolutely. I mean, you know, like when I talked with Joey, agree. Like he said, all the things that you could buy in Walgreens, other than going for a prescription, it's tap on your phone, you have it the next day. It'd be a lot cheaper. So, yeah, I agree. And Costco has a pharmacy, right? So,
Right. Yeah, I think that makes sense. And I think Amazon is giving it to UPS as well. That's one of the reasons I picked them to sell out of. Is we'll just have to see where the future goes for those guys. They might be riding in second place before too long. So who knows?
I wouldn't invest. So, and D's Div says they moved all their regular scripts to the online guys. That's very interesting.
Yeah.
We haven't yet, but we're still old school, I guess, in that way.
Yeah, B Still Sound says Amazon is giving UPS the business. You guys seen that meme or that short video where the referee throws the penalty flag and he comes out and he says, personal foul. He was giving him the business.
I didn't see it, but I like it.
It's hilarious. It's like real. I mean, it's like, that's what the guy said on the field. It was really good.
That's funny. So it was a real event.
Yeah, it's a real event, real football game, and it was really funny.
Huh. That is funny.
Yeah. So where you guys see yourselves going in 25? Any changes to the way you're investing now? Any not necessarily specific investments, but are you going to do anything differently in 2025 than you did 2024?
What do you think, Russ? Let me kick it off.
Yeah, I mean, I'm always changing and evolving, right? As new facts come into my mind and experience, I'm going to change with it. And I mean, that's the smart thing to do. But I think focusing a little bit more on I guess, two parts: on total return investments, and then on higher, little bit higher starting yield, but higher growth. So finding some investments like that, like Vici. Vici has a 5% yield. They've been growing it at about 5% a year, that dividend. So something like that. I mean, they're not that easy to locate, but yeah, and then just starting to pay back this money we took out of the taxable account.
Yeah. Yeah, I can't say I have any super big changes ahead other than, I don't know, guess the direction I'm already going down. Like Russ says, this is a journey of constant evolution, which has been a lot of fun. I think I'm going now into my 5th year of doing this, and I feel like while I still have so much to learn and experience, I feel like I've come a long way and it feels good. I feel like the portfolio heading into 2025 is at a point where there's not too many drastic changes I feel like I need to make. Feel like I have really solid balance across the entire portfolio. I look around at the stocks on my watch list and the ones that I'm serious about, and there's really not, I just feel like there's not too much more out there that I would care to own. I think my somewhat serious watch list is maybe maybe 17 to 22 companies. And I don't see that ever becoming too much more extensive than that. Like, I don't ever see there being a time where I have 35, 40, 50 stocks on my watch list that I could pull the trigger on at any time. I kind of becoming a bit more focused, and it's just based on ones that I understand. They're just kind of more simple in nature. That's where like a company like Rollins comes into play. Super easy to understand pest control.
That's on my watch list too, for sure.
Yeah. So I think heading into 2025, I'll just keep my sight set on that focused group of companies and continue, because some of them I haven't done super, super deep research into. I've just, spent a little bit of time with them enough to know that I'm mildly interested. But I think in 2025, I'd like to continue chipping away and doing some more deep research into those and maybe just refining that list a little bit more, adding some more things as they come along, subtracting things as I go through them. But that's kind of the process for me moving forward, I think.
Gotcha.
Yeah.
Yeah, I think for me, I'm gonna try to hold around this 25 stock limit for my portfolio. I think I'm at 27 right now or something along those lines.
Nice.
So yeah, I have
Are there
27 holdings.
that you're thinking about getting rid of?
Well, the ones that I got rid of, I got rid of UPS. That was the one that, let me kind of just flip through. I mean, there's some that I, depending on what happens, I might get rid of. I've got a company called Graco, which makes
I was going to ask you about that one.
Yeah, it makes the like paint guns and stuff like, commercial paint guns, and they're coming out with some new and innovative products. But they're a smaller company, right? They're not. I say they're not a small cap, but they're probably more of a mid cap company. And but I mean, I'm up 14% on them, but they're not growing really fast, and their dividend yield is not very high either. So it's it's doing fine. So as long as it's doing fine, I'm going to leave it alone. But if they kind of outgrow themselves, then I may get rid of them. They're only 1.6% of the portfolio though, so it won't take much to get rid of that. It's just a small piece of the portfolio.
Yeah.
Looking at some of the rest. Here's one. I know we're running over, but there's always something fun to talk about. I really had in my mind today, why am I holding on to Stanley Black & Decker? I've had them for years, and I'm way down on them. So I got rid of Whirlpool. Whirlpool was my worst defeat as an investor. It holds the number one position for that. Stanley Black & Decker, not so much. Let me see what I'm down on it. This spreadsheet calculates for me what my historical return is on these things too. So Stanley, I'm down about $17,000 on Stanley altogether. Whirlpool was $31,000, just to kind of give a sense for that. So $31,000 is the worst beating I've ever taken, and that was Whirlpool. So I've got Stanley at 17. I keep thinking maybe it'll come back, but it's not one of my top stocks in my list, right? So what am I doing? Am I gonna, put my money where my mouth is and say my model says it's like 3/4 of the way down the list? I got 92 stocks in that list, so there's a lot of stocks that I would go through before I bought Stanley Black & Decker in my new model. So why am I holding on to it? So I don't know the answer to that yet. I've got to wrestle with that. I think, Ryan, what you said about, as things evolve, maybe it was you, Russ, as things evolve, we change. And so that's kind of in my mind. I mean, what do you guys think about Stanley?
I think
Should I hold it, or?
I think there's an opportunity cost to that. I've heard it put this way. This is something I struggle with, but there's a prevailing thought out there that if you wouldn't buy, it could go both ways, because they've said if you wouldn't buy a stock at where it's at today, then you should sell it. It's too overvalued. Or if you wouldn't buy it, if you're holding something and you wouldn't buy it again, if you didn't own it, then you should sell it, So I don't know. I don't fully agree with that, because if just because I wouldn't buy AbbVie, I don't know. I don't think I want to. I have 25 shares of it, but my cost basis is in the 80s. It's ridiculous. But so I don't know, man. If you don't want it anymore, if you have a better idea, I mean, here's me. It's right easy to say that, but people that are far smarter than I have said that if you have a better idea, then you should probably sell the thing you don't want, cut the weed, water the flower with that with those funds.
Yeah, I would say the same. I guess in just thinking about the business, I don't know enough about it to really give a good opinion about it. But and I'm sure there's a lot of competitors, a lot of other tool brands out there, but what would drive people to buy Stanley Black & Decker's tools over a different brand? Is it price that drives those decisions? Is it quality? Is it a combination of the two? Which one is more heavily weighted in that decision? And where does the company fall within that? I think, and I'm probably overcomplicating it, don't need to get into the weeds on all of that here either.
Mhm.
But those are the things I would think about. And if they come out favorably in that, looking at all those factors, then I don't know, maybe it could be a good one to hold on to. It's from what I remember, I haven't looked at it for a while, but it's pretty nice dividend. So, it doesn't hurt things if you can be patient and wait for it to come back. But then, like Russ said, as Russ has said before too, you don't have to make the money back the same way you lost it. Right. So yeah, if you find a better opportunity in the meantime, then probably good to unlock that capital and put it elsewhere. But I would ask you too, because maybe there's some symmetry here. What was the final straw with Whirlpool? Like, what ultimately led you to feel good about letting that one go?
Yeah, where that got was the dividend became in question at some point. It's not there anymore, but it got to the place where the dividend was in question. They didn't have enough cash flow to support the dividend, and that again has changed. But I sold it at that point, never re-entered it. I think I'd be doing better on Whirlpool if I just stayed in it. But at the time, you can only go with what you see. And I just didn't want them to cut the dividend or eliminate the dividend and me be sitting there holding those shares. So, but Stanley's not in that place,
Right.
Well, if you're also in no hurry, if you don't think they're going to cut the dividend and, you're not in a hurry, then I don't know. If you don't know, then just do nothing maybe.
Yeah. And I guess too, like, I don't know, Kevin, and where you're at in life, I know total returns are important, but are you more concerned about the dividend income than you are seeing the value of your portfolio go up?
That's a great question. I think for me, because I have other streams of income other than dividends, that I don't necessarily need the dividend income today. I will need it in the future.
Yeah.
So I need to be building it, right? But it's not necessarily the most important thing for me at this point. And so I was talking to Zal actually in the Discord about that, because he was thinking that my portfolio had only high dividend yield stocks, and so I made a copy of my dividend yields, and probably my 10 companies out of my 27 have less than 1% dividend yield. You know what I mean? So yeah. I think it's I look for that total return. That's what I'm growing into, I think.
Well, I think if that's what you're emphasizing, so part of this is playing the game still. You're playing the game, trying to grow this thing as big as you can. And if that's it, then it probably just comes back to what Russ said. It's opportunity cost.
Yeah.
Yeah, Stanley, I'm looking at it, Simply Safe. I mean, it doesn't look terrible. I mean, I don't think the dividend's in any jeopardy. So, earnings are coming back a little bit. They fell off a cliff there in 22 and 23,
yeah.
But
yeah, I rode that all the way down, man.
Yeah.
But then again, you could be getting weekly dividends with QDTE. So got to consider that too.
I want those daily dividends.
Oh, they're coming, Russ. They're probably not too far off.
If somebody will buy it, Wall Street will sell it, right?
Awesome. Well, guys, I have thoroughly enjoyed this hour and 18 minutes. We've got to do this more often, and I will throw some more dates out there coming up in the new year. I know you guys are busy, and so I don't want to ask you every week, because I know you got things going on and stuff, but it would be cool every couple of months or so to kind of do something like this. So. Yeah.
Hey, maybe sometime after the turn of the year, we can get together on the dividend happy hour sometime. Maybe once we get the first week or couple weeks of 2025 under our belt, it'd be good to just kind of see how things have, how we've all kicked off the year. That'd be kind of fun.
Yeah, and even how we ended up the year, right?
And
yeah, exactly.
What is it? The shared stream. So yeah, it's kind of.
Oh yeah, that's cool stuff.
Yeah, I don't know if it's gonna make So is this? I don't know if this will be a video on my channel now too. Like for
Yeah, I
people
think
to,
it will.
to watch.
Yeah.
I
I
don't
would
know,
imagine
but
so, yeah.
This would be a really cool thing. Now this just opened up a whole other world for me to, like,
Yeah.
well, why not? If we're talking, that's
Yeah.
broader. Get everyone involved.
Yeah, and
so.
there is an option inside. What is this that we're in? That with the
StreamYard.
Yeah,
Yep.
StreamYard. There's an option when you set the live stream up to allow your visitors to stream it also. So just make sure that's checked. So I went ahead and
never
checked
noticed that before.
Yeah, yeah. Cool.
Cool.
Awesome, guys.
This was fun. Kevin, thank you so much for having us. I will literally do this anytime. So don't ever.
Okay.
Yeah, anytime. This is a blast. So thank you for having us. Truly an honor
you.
to be here for the 50th episode. And all of you guys still tuning in, thank you guys for hanging out with us this last hour and 20
I
minutes.
may be
We appreciate
busy,
it.
but I'll make time. Oh, dude, I cut you off. Sorry. Didn't mean to talk over you.
Sorry, man.
I said I may be busy, but I will make time. So yeah.
Awesome.
Thank you.
All right, man. Well, guys, it's been great. And thanks to everybody who's joined us. It has been just a fantastic show. If you're just now joining, I saw one just popped in. Catch the replay because I think you're going to enjoy the conversation. So, guys, I will see you soon.
Yeah. See ya.